If you've lived and worked in both the US and Canada, there are tax forms that you need to be filing on it every year in order to avoid thousands of dollars of penalties. Today, we're going to talk about different tax forms that you need to be aware of as a cross-border retiree. Hey everybody, my name is Brian Haggard. I'm the CEO of Retirement and Financial. We help simplify your cross-border retirement plan. Now, I'm going to start this video off by telling you I am not a tax preparer. We do tax planning for our clients, meaning that we take a look at all of our clients' situation and we help them and develop a strategy to take account withdrawals from their US and their Canadian retirement accounts to help them minimize their taxes and maximize their long-term income. We look at all of our clients' taxes on a year-by-year basis, and we help them develop strategies to do this. But we don't file clients' taxes. We don't prepare clients' taxes for them. I just want to bring that up because ultimately I always get that conversation or that question after doing these videos. Hey, Brian, can you file our taxes for us? That's just something that we don't do. So I want to use that caveat beforehand. But we are, by looking at hundreds of tax returns on a year-to-year basis, we do work closely with cross-border CPAs, so we do know what to look for and we know what's right and wrong. Today, we're going to talk about a couple of different tax forms that you need to be aware of, that there's a good chance that some, if not all of these tax forms, you should be filing on a year-by-year basis. The different forms that we're going to talk about today are the fbar, the Foreign Bank and Financial Accounts form, the Form 8938, the Statement of Foreign Financial Assets, the Form 1116, which is the Foreign Tax Credit form. We're also going to talk a little bit about the pfic statement, but hopefully that is not a form that you need to file. We're going to talk about ways to get around it if you are currently filing it. So let's start off with the form that is probably the most common. Most of our clients file this form, or they should be filing this form, and that is called the fbar. The fbar is kind of the, I guess, short name for it or the nickname for it. It's also called the Foreign Bank and Financial Accounts form. And why is this form so popular? As popular as so many people have to file it. Well, an fbar is filed as long as you have more than $10,000 in foreign accounts. Now, that $10,000 is the maximum that you had that year, right? So they take a look at whatever the highest values of are all of your accounts combined. And if you exceed over $10,000, you need to file this on an annual basis. Now, some people will say, Brian, I don't have to file the fbar because I have RRSPs or liras. All my accounts are registered accounts. Still, we recommend, and most people will suggest, even if all of your accounts are registered, you should still be filing an fbar on a year-to-year basis. Now, an fbar is not technically a tax form. It's due the same time as your taxes, but you actually don't file your fbar with your taxes. You electronically file the fbar through FinCEN. It's an online government website. And FinCEN's actually the Financial Crimes and Reporting Network. So you don't send this to the IRS, you send it to a different place, but it's still really important that you file this each year, because if you don't, you could face up to $10,000 in penalties per year for failing to disclose your international accounts and assets. I work closely with a couple of cross-border CPAs, and whenever I refer clients to them, the first thing that they ask me is, Brian, are they filing their fbars? It's really important that you are filing the fbars if you haven't. Now, if you haven't been caught, if you're not under review, you can go back and file past fbars. That's something you may want to do if you haven't been doing that in the past. The other form that you want to be very familiar with is the Form 8938. Form 8938 is very it's very similar to your FBARs. There's just a little bit higher of a hurdle to get past on the Form 8938 than there is on the FBAR. With the FBAR, you file it as long as you have over $10,000 of total foreign accounts or foreign assets. The Form 8938 is only filed if you have over $50,000 of foreign assets if you are single, over $100,000 of assets if you are married. Now, that is the aggregate amount of your account. So if you have 10 accounts all at $15,000, you'd have to file this Form 8938 because the total amount of your accounts exceed the 50 or the $100,000 if you're married. The Form 8938 is a little bit different than your FBAR. The Form 8938 is filed with your tax return. And quite honestly, TurboTax, a lot of the families I work with, they just use TurboTax. And nowadays, TurboTax will even ask you, hey, do you have this much in foreign accounts? And if they do, they'll actually help you file these Form 8938 as well. So it's not overly difficult, the Form 8938. It is a minimum 2-page tax form. The first page kind of lays out all of the different, how much you have total up in Canada. And then the second page, you have to list each account that you have. And you have to, each account is listed separately on a page. So if you had 10 different accounts up in Canada, RSPs, liras, bank accounts, you name it, you'd have to list each one of those separately, and each one would include a different page. So it can be a little bit onerous if you have a lot of different Canadian accounts. However, the penalties are still pretty high if you're not filing this on a year-by-year basis. The penalties may be up to $10,000 per year for a maximum of $50,000 if you're failing to disclose your financial assets on the Form 8938. Now, a lot of the penalties that we talk about are people who are trying to get away with reporting their Canadian accounts, or trying to kind of have these accounts that they're trying to kind of dupe the US government with. There is a possibility that if you just are naive to filing these forms, that you may be able to get away with any penalties. But I would strongly suggest filing these forms just in case that the government does come and tries to audit you at some point. The other form that we see very, very often is Form 1116. It's also known as the Foreign Tax Credits form. And this form's a little bit different than the other forms that we talked about previously. So again, the Foreign Tax Credits form is filed with your US tax return, but the other accounts, if you have assets up in Canada, you need to file those tax returns, those tax forms. The Foreign Tax Credits form is really only used when you start taking withdrawals from your accounts up in Canada. So usually we see these forms if you have Canada sourced income. So for example, maybe you're in the States and you have a job up in Canada. Maybe you have some RSUs or employer options that are still vesting for you that were originally granted in Canada, but now you're in the States. Rental property, if you have rental property in Canada, we see this form a lot. But the big triggers would be like if you're taking RRSP or lira withdrawals, that would all be reported on this foreign tax credit form. Now, pension payments also would be, so like if you have a company pension or maybe a municipality pension, you would also probably report this on the foreign tax credit form. I typically don't see CPP or OAS included on the foreign tax credits form. And that's just simply because CPP and OAS does not have tax withholding on them. The other accounts do have tax withholding on them. And the foreign tax credit form helps us get that tax withholding back. So, let's talk a little bit about what the importance of foreign tax credits for you. If you're a US citizen, which means that, if you're a US citizen, you always have to file US taxes, right? So even if you're in Canada, you have to file US taxes. If you're a US resident, you also have to file US taxes. But as a US citizen or as a US resident, you pay taxes on your worldwide income. So even if you have rental income in Canada, if you take a withdrawal from your RSP in Canada, if you're collecting CPP or OAS in Canada, you still have to report that on your US tax return. The use of the foreign tax credit ensures, or at least helps, that you are not double taxed. So kind of how the foreign tax credit works is this. Let's say that you take a $10,000 RRSP withdrawal in Canada. What would happen is Canada would withhold 25% or $2,500 from that withdrawal. Now, you still have to include that $10,000 on your US tax return, whatever the US dollar equivalent would be. But in order to avoid the double taxation, then the $2,500 that you had withheld in Canada would count as a tax credit to offset the taxes that you have due from that $10,000 withdrawal here in the States. So the foreign tax credit form, should be very beneficial to you. You don't want to miss it if you're taking withdrawals from your retirement accounts, or if you have pensions, or really anything up in Canada where they are withholding something. Now, I will just mention this really quickly. Most of the clients I work with, if they are US based, if they're US residents, either citizens or residents of the US, they typically don't file Canadian taxes. There may be some reasons, rental income, maybe they sell a property up in Canada in which they would, but most of my clients do not file Canadian taxes. They just file US taxes, and Canada will withhold money from certain withdrawals or pensions. Now, I will say it may be beneficial to file US or Canadian taxes. It's possible that you can get the withholding that Canada is doing down lower, and that may help your US taxes out as bit if you are a lower income earner and the withholding done by Canada is much higher than what your US tax rate may be. So you can, I do have a couple of clients that do file Canadian taxes. A lot of my clients just kind of don't want to worry about it and just have the withholding done on Canada's side and take it from there. The last form I want you to be aware of, but I hope that you're not filling it out, is called a passive foreign investment corporation form. Again, this is kind of short for all of these terms. All these names are really long. They almost all have nicknames, right? And this is called a pfic form. Now, this form you need to fill out if you have mutual funds or exchange traded funds, ETF, Canadian dollar mutual funds or ETF, in non-registered Canadian accounts. So if you have, let me just give you an example. If you have an RBC account up in Canada and you have Canadian-based mutual funds and Canadian dollars in that RBC account, you should probably be filling out these pfic forms on a year-to-year basis. And these are a huge pain if you have to fill these out. First of all, this is a 6-page document for each investment that you have. I recently had a client that came down and moved his investments from Canada to the United States. And while he was doing this, he, as a US resident, he still had about 20 mutual funds in a non-registered account up in Canada. He had to fill out 120 different tax documentation for each page that he had in these pfic forms. They are a huge headache. You can imagine how much he didn't want to deal with this, as you can imagine. His tax preparer charged him thousands of dollars for these pfic forms. Not only is it a pain because you have to file all of this paperwork with your taxes, you also, if you are subject to the pfic, you have to pay taxes each year on any unrealized capital gains. So even if you didn't sell anything, even if your investments move up in value, you still need to pay taxes on that. Again, these are just non-registered accounts. If you have mutual funds and an RRSP, a LIRA, a REIR account in Quebec, you don't necessarily need to deal with this. This is just a non-registered account. So you do want to avoid this at all cost. I typically will recommend for clients like that I had that moved everything down to the States, if you have these non-registered accounts up in Canada, if you want to invest that money, I will typically recommend getting that money down here to the States to invest it. I get it, the exchange rate's pretty crummy right now, but honestly, typically your investment options are much better if you are a US resident to invest that money here in the States, and the taxes are going to be quite a bit easier for you. Now, if you just say, I want to keep the money up in Canada, we're moving back to Canada, as a result, you still have to file US taxes. I would probably recommend in that situation that you buy individual stocks up in Canada. If you own individual stocks, you don't need to fill out this pfic form. It's really just if you have non-registered mutual funds or ETFs in a non-registered account up in Canada. But if you can avoid this form, please do at all cost. It can be quite a pain for you. Again, my name is Brian Haggard. I'm the CEO, founder of Retirement and Financial. We help simplify your cross-border financial planning. Tax planning can be really complicated when you've lived and worked in both the US and Canada. And that's what we really specialize in. We help our clients put together a plan to minimize their taxes and to maximize their income. If you're interested in talking to a cross-border financial advisor, you can go to our website at retirementin.com and schedule a complimentary consultation. Thanks. We look forward to speaking with you soon.